Hi, this is Mohammed. We are here to our next webinar series called Tax Efficient Hedge Fund Strategies and Management Company Taxation. We have a esteemed panel here. They will, Greg will moderate and Elizabeth and Alex will participate. I will be doing most of the housekeeping items. So for attendees who are they will get the CPE certificate from us if they answer 3 out of 4 questions. They have to listen at least 50 minutes out of 60 to be eligible. Greg, please.
Perfect. So the program level is basic. There's no prerequisites and no preparation required. This is generally informational for all participants in the industry to understand the tax efficient hedge fund strategies of both the management company and the funds themselves in some cases. Mohammed, can you make sure that we're sharing the presentation? I don't see it anymore.
Okay, thank you.
There we go. Perfect. So the panelists today is Alex Cummings from Akram and Elizabeth Leek from Fund Services Group to speak about these matters. I'm on the panel from FundViews Capital as the moderator, keeping us on the railroad track, so to speak. So you can go to the next slide, Mohammed. And Alex, do you want to start by giving kind of a very brief introduction on Akram, who you are, what they do, et cetera, and your role?
So, thank you, Greg. So Akram Associates provides accounting and fund auditing and tax services for the fund industry. We do audits of the funds themselves, accounting for various entities, tax returns for the funds, management companies, GPs, principals, and provide support services to family offices.
Great. Elizabeth, do you want to talk about yourself and Fund Services Group?
Sure. Fund Services Group provides a full suite of middle and back office services to fund managers so that they can focus on fundraising and investment decisions. Everything from operations, accounting, compliance, IT, and investor support. So we currently support over $8 billion in private and registered fund assets. So we're able to support any size company.
Perfect. And my name is Greg from FundViews Capital. FundViews Capital is similar to Fund Services Group in some ways, but we're more focused on a platform solution for advisors, small family offices, and emerging managers is really our core focus. But similar in some ways with the outsourced back and middle office support work. We can skip to the next slide. So as an introduction, we're going to explore different tax strategies that hedge funds and management companies can implement to minimize their tax liabilities. We're going to discuss different concepts and regulatory considerations, best practices, and compliance with tax laws in some circumstances on today's call. Whether you're managing a hedge fund or you're a service provider or work with hedge funds, I think this presentation should provide a good insight into various things that can actually affect you, even if you're not managing a hedge fund. If you're managing a company or help others manage companies, it could also be beneficial. So it's a bit of a wide array of topics. Let's skip to the next one. So on the hedge fund agenda side, we sort of split this up into 2 groups. So the hedge funds agenda is really focused on what you see there. I don't have to go through them because we're going to go one by one. And then we're going to go through the management company considerations as well. So we'll skip to the next slide. So when to recognize wins and losses, so tax loss harvesting. Alex, do you want to kind of take us away on this one?
Sure. So generally, it's advisable for managers to look, or taxpayers to just look at their portfolio at the end of the year as they get near the end of the year. Any positions which you have significant losses in, it may make sense to recognize that loss for tax purposes. If the value of the portfolio drops, but you don't sell the position, it's just going to be a book loss and not available for tax. So if this is a practice that makes sense, there's a couple things to think about. First of all, it would be good to do before the position is over a year old if you're planning on doing tax loss selling. The reason for that is if you sell the position, let's say you sell the position in November, but it was over 12 months already, that loss is going to be a long-term capital loss. And there's a netting process that occurs at the individual taxpayer level, where first, long-term losses offset long-term gains. If you sell it while it's still short-term or less than 12 months or less, it'll offset short-term gains. So that's preferable. And the other thing you have to be wary of is if you plan to reacquire that position, you have to wait 31 days before getting into that long side again. And that could be before or after the trade. So you're going to get tagged with a wash sale, which means that loss will be temporarily disallowed if you reacquire that position in that 30-day window.
Thanks, Alex. And one question on that: is it common that you would sell, a stock that to get the tax loss, and then immediately buy similar stock in the same industry? Is that allowed, or is that not allowed?
Yeah, it is allowed. The rule for the wash sale is it has to be substantially identical, meaning that it effectively has to be the same position.
Got it.
So one strategy that people may use is if you have a big loss, and let's say, oil producer, you might be able to, realize that loss and immediately go into a comparable company. Maybe the whole industry, the whole sector has gone down, and that can give you exposure back on the upside. The other thing you could do is, an index or something like that. But if you're planning on maintaining exposure, it has to be a different ticker, essentially.
Yeah, got it. All right, good to move to the next one. So miscellaneous itemized deductions. Do you want to take us through this one, Elizabeth?
Sure. Under the TCJA that was passed back in 2017 for the 2018 to 2025 tax years, miscellaneous itemized deductions were no longer allowed. You couldn't utilize that 2% floor anymore. And so a lot of funds that are treated as investor funds have been unable to take deductions at the investor level. Obviously that's different for trader funds, but you've got types of deductions such as audit fees, management fees, organization cost amortization, administration fees, and legal fees that are all disallowed at the investor level. There's a few things that can be done here to mitigate this a little bit. One thing we see is, detail analyzing legal fees to see if anything can be capitalized as deal costs or capitalized as organizational costs. The other thing we've seen is for tax purposes to stop amortizing organizational costs since they can't be deducted. And then when the fund winds down, it's just an increase in the tax basis that can be taken as a loss.
Got it. And so what do you think would be one of the most important things that people should watch for end of legislation in 2025?
I think the most important thing to look for is to see if this law changes back to if it sunsets. With the new election, it's going to be, the election that just occurred, it's going to be difficult to determine exactly where we're headed, if this is going to be extended or not. I know we're going to cover a little bit of that later, but it's hard to predict at this point.
Got it. Yep, perfect. Next slide. So Alex, do you want to take us through this one?
Sure. So the miscellaneous itemized deduction issue, one area that hit particularly hard was, folks that are investors by sort of design, and that's your family office, right? So if you have a family with a lot of wealth, tend to be fairly conservative in their investments. Most of the investing activity is done with other managers, so any costs incurred are going to fall into that classification. So if you have somebody that has, significant enough wealth they can form what is known as a family office structure. And that's where a dedicated management company is formed, and the expenses of running that family office are paid by that company, typically a C corporation. And to fund that, the structure a carry or an incentive that is paid from the pool of invested capital. And what that does is, let's say the overhead for running the family office is $2 million. Hopefully they'll come up with an incentive structure that will, cover at least that amount. But let's say that, that pays an incentive of, 2.5 million. That reduces the taxable income to the family by 2.5 million. And that's where the tax savings comes in. If it were simply just paid out, the fees paid out, those would all be deductible. This way, you have $2.5 million of income flowing into the management company, also with $2 million in overhead, and there's still a net profit there. But you get, a big savings. The other thing you can do, let's say you're not a family office and you're investing in outside managers, especially with an investor type fund that you think will have a steady return, you may be able to go into the offshore fund if they will allow you to do that, and they could provide you with something known as a PFIC annual information statement. Think of it as sort of a 1099 for an offshore fund. The reason this is helpful is because it's a corporation, that all expenses just net with ordinary income. So there is no portfolio deduction concept within a corp, and you can still get your long-term capital gain rates flow through that PFIC. There's a few other trade-offs. You're going to lose, qualified dividends, foreign tax credits will not flow through, and you're going to be subject to withholding tax on any U.S. dividends. So an analysis needs to be done, but it's an effective planning tool if you're investing in a lot of outside managers that are investor funds.
Thanks, Alex. And do you think it's more or less, it sounds like it's dependent on a lot of varying factors. Is it more or less beneficial in high versus low tax states? I'm assuming it's more beneficial to high tax states to kind of look into using incentive allocation as a.
Yeah, for sure. Just because your effective overall tax rates can be higher in these high tax states. And really with either one of these structures and really any sort of sophisticated tax planning, modeling should be done, because while you may solve for one issue, like the portfolio deduction problem, you may introduce other risks or other tax inefficiencies, and you sort of want to net that out and make sure that it's still a benefit.
Got it. Thanks. So I think we're ready for our first polling question. Perfect. So beneficial tax elections. So Elizabeth, did you want to walk us through these two?
Sure. For 475F, the mark-to-market election, this is essentially where at the end of each year, investments are mark-to-market. This means that any unrealized gain or losses, whether you've sold the position or not, are treated as if they were sold at fair market value on the last trading day of the year. This obviously has its benefits and pitfalls, just like any other tax election, but we can walk through those as well if you'd like. Some of the benefits include the ordinary loss deduction that that investors would be able to take advantage of if the fund has substantial losses. So typically with capital transactions, so capital gains and losses, your losses are limited to $3,000. With ordinary loss deduction, your losses are pretty much unlimited there. So they can offset any type of ordinary income. You also avoid the wash sale rules that Greg talked about, so there's no need to do tax planning at the year end as it relates to that. Also simplified tax reporting, since we're just taking gain as of the mark. And then there's some net operating loss flexibility there as well with the 475F election. The drawbacks, however, are funds that have a lot of long-term positions. Obviously, with the 475F election, you're taxed at the higher rate there, and you're not able to take advantage of the capital gains tax rate, the preferential rate. In addition, this mark-to-market election may push some of your investors into a higher tax bracket, and that income will be treated as ordinary. So you've got to weigh the benefits of deducting those losses under 475F, because this election could be very disadvantageous. And lastly, the election is irrevocable. So once it's made, it's permanent.
Interesting.
And then on the 988 elections, these are currency transactions. So an election can be made on each one to treat that ordinary income, which is typically ordinary, as capital income. And if it is, traded, if it's regulated trade on, then it would be subject to 1256 if it's a contract. And then that would receive preferential treatment of 60% long-term gain, 40% short-term capital gain. And Greg, please hop in there if I missed something.
No, that all sounds and looks great. Yeah, anything to add, Alex?
Yeah, the thing with the 90, thank you, Elizabeth. The thing with the 988 MLB election, where it's a little tricky, is the manner that which you're supposed to make it, like the 475 election. You attach a statement to your return. You put the gain and loss in a particular form, and you're good to go. The 988 MLB election, it's a contract by contract election, and the guidance and the regulations tell you that you inform your broker before you enter any trade, and there's really no mechanism for doing that. And clients that we've helped in the past, say reach out to your broker, and the broker's like, what are you talking about? Like, we don't know anything about tax elections. So you generally have to be a little bit creative in how you're going to do that. You also tend to make a blanket election. So, go something like you send a letter or memo to your broker and you say, for this account starting on this date until, further notice is given, we intend to have this election apply to any trade entered into. And, kind of prove that you sent that there, include a copy in your return kind of thing. And you should be good to go. But it's a little odd as far as like how you actually make the election.
Interesting. Yeah. Sounds like it. Does every broker kind of understand the mechanics behind it, Alex, in your opinion, or is it?
Not at all. They never know what you're talking about. And why should they? That's not really their business. They're there to, help you, get access to these markets and execute trades. And, it's just an oddity. So, I've seen some clients ask the broker if they could add a statement, add language to the broker statements. Like, can you just go in and like make sure that this is printed on the statements? So I've seen that, but it's probably like you're talking to your account rep or something rather than anybody else. Yeah.
Yeah, they're not really providing tax advice, right? So
no.
So great. I think we're good to move on. So the kind of an important one is sunset of certain Tax Cuts and Jobs Act provisions, TCJA provisions. So given this past week with the election, again, there's a lot that's up in the air and people don't know what the end result is going to be on this stuff. But there's more. I think we can all agree there's a higher chance that a lot of these Tax Cuts and Jobs Act provisions get extended or made permanent in some cases, at least over the next 4 years. So we'll see how that all plays out, but maybe we go kind of one by one and discuss some of these issues, and one of the more important ones. So SALT cap of $10,000 for itemized deductions. I don't know if Alex or Elizabeth, whoever wants to jump in and touch on that.
Yeah, I can grab that. So basically, this is the folks that live in a higher tax rate state tend to be hurt the most. So let's take a New York resident. Let's say New York City resident. Excuse me. State and city tax is 14 and some percent. So you could see you could get to a $10,000 tax expense rather quickly with that high of a rate. And effectively, what happens is any amounts paid over and above that won't be allowed as a deduction if you're itemizing. So as of right now, all these provisions are set to expire at the end of 2025. So what this means is for 24 and 25, absent any changes in legislation, all these things will revert back. So if this doesn't get extended, that means the people that were being disallowed these deductions will get to take them again. So that could be very helpful for a lot of folks.
In high tax states.
Correct. Yeah. I mean, honestly, even in a moderate tax state, if you're wealthy hedge fund manager, high net worth investor, you're still probably going to get hit. So it really benefits anybody that pays state tax.
Got it. So marginal tax, and when you say benefit, we should be clear. It benefits if the Tax Cuts and Jobs Act doesn't get extended, it would benefit.
Right. Yeah. This is a cut. This is like a reduction of a deduction, right? So there are things in here that lower taxes that when they expire it goes up. This is one that actually helps it go down for a lot of folks. And just move on to the next.
Going to marginal tax rates increased.
Yeah, so everybody got a reduced rate. All the rates were lowered, and if the sunsets with no extension, they're all going to go back to the pre-2018 rates. Likewise, standard deduction, the standard deduction was increased dramatically, and along with that, personal exemptions were removed. So if people remember that far back, if you had dependents, you got a few $1,000s. I don't remember. I think it was maybe 3,500 or 4,000, somewhere in that neighborhood. That reduced your taxable income by that amount. So those will flip back. So we're back to a lot more people itemizing.
Yeah.
The miscellaneous itemized deductions, which we spoke about earlier, come back. So these have a 2% floor, meaning that to the extent that the amounts that you incur exceed 2% of your adjusted gross income, you can get a deduction. That sounds like it's still limiting a lot, but we certainly saw back when this changed, a lot of taxpayers that were getting some benefit see that eliminated. So it certainly had an impact. So again, this is one of the things that will help people if it expires. And then there's a few other provisions, but these are the main ones. As Greg, as you already touched on, sort of don't know how this is going to go. I think if we think back to how the TCJA came into existence, it was passed right at the end of 2017, which was almost 2 years into his first presidency. And while there's a expectation that there will be some tax legislation, I think there's a lot of things that could go along with it, right? It might be part of a consideration, maybe there'll be tariffs that, want to be added. That's been discussed. A lot of times, some of these things are part of funding bills or, border security or all these other things. So while there is a feeling that some or all or these or maybe other changes will be made to keep an eye on, it's just hard to know how soon that'll happen or what exactly that will look like.
Yeah, good point. And even though it took till 2017 for this to go through, it was actually, I remember reading a long time ago when it first came out that it started under Obama's administration, and then it got kind of morphed and changed along the way. But it took even longer than the first 2 years. It was started prior to that. They were working on it, so it can take 4, 5, 6 years sometimes, depending on obviously a lot of different factors that are above our heads that we have no idea. So we'll see. Anything to add, Elizabeth? Anything that you've seen on the Tax Cuts and Jobs Act?
No, it'll just be interesting to see if they push something through as part of like a budget reconciliation or something like that. So no, I really haven't seen much different.
Perfect. All right, next slide. So PPLI, or private placement life insurance, and IDFs, insurance dedicated funds. So I can speak to this a little bit, and then hand it off to Alex and team to kind of touch on a little bit more. So in my opinion, the PPLI is really an insurance wrapper around a fund, or an insurance dedicated fund is an insurance wrapper around a fund structure. It can definitely help grow, especially grow investor wealth, especially when there's high tax type of income, like private credit is a big one, with a lot of interest income. However, not without its drawbacks. It's really best suited for ultra high net worth investors that have quite a bit of excess capital, because they're really putting it in a vehicle that is no longer liquid to the same extent that it used to be. Liquidity and control are really the biggest two trade-offs. For the insurance to work, for the wrapper to work, you have to sort of give a lot of control away to third parties. So you really got to trust the third party that you're working with. And the whole goal of an IDF and PPLI is to grow tax-free or tax, deferred, we'll call it, for multiple generations, right? It's a very long-term, it is over the long term very helpful, but most people want to spend their money in their lifetime, and there's less people that want to, grow for their grandkids and grandkids' kids. So it can be tricky, but it is beneficial. So Alex, I'll let you kind of touch on that a little bit more if you want.
No, that's really good. I agree with everything you said. I think where we see this being interesting to folks, it's where you have the people that have sufficient wealth that they're pretty heavy into estate planning, and the estate tax, kicks in. I don't know the exact limits off the top of my head, but 11 or 12 million, like, sort of per person. So let's say you have a married couple, they can
Well, that's one of the things that was a hot topic a little bit in the campaign trail with the two recent candidates. Was Trump wants to keep it at 14 million, which changed when he was in office, and I think Harris wanted to reduce it to a lower amount. But
yeah, I mean, I've even heard that there's talk about eliminating it. So I'm not sure
yes.
how much traction that would get. That doesn't seem to be very politically popular. I sort of kind of agree with that. It's really only benefiting the very wealthy. So if it's 14 million, you have a married couple, like 28 million, they can of wealth they can give out before they're subject to the gift tax. So let's say you exhaust that, and then you have more assets that you would like to see escape the state tax. You can take a chunk of that and put it into one of these insurance policies that's invested in alternative managers that grows tax free, and which obviously helps the compound, and then will pass to sort of their heirs when that time comes. So sort of think of it as a combo estate planning and income tax planning tool, and it does avoid both of those taxes. So I think it's in that conversation of families that are in that position where it could become interesting.
Yeah, and as with everything, there's always a cost to the insurance and a cost to running that that entity or that insurance product, right? So if you're only looking at $1 million, if you're at 29 million, right, across the two, it's probably not beneficial. If you're at 5, 10, 15 that you want to put in this type of stuff, then it could be more beneficial for those people. Perfect. So next polling question. So tax basis concerns, GPs of funds. Alex, do you want to start with this one, and then Elizabeth, if you want to add on at the end, that'd be great.
Sure. Yeah, this is something that we've seen be kind of a trap for folks that are not familiar with, let's say a new fund manager, even a experienced fund manager. They're not familiar with kind of the timing of the taxable income as it relates to the awarding of the incentive, right? So if we think about a GP, typically they're not funded with capital. As they earn incentive, that gets credited to the general partner, but that's a book number, right? So let's say a manager gets $1 million incentive that's awarded to them in their first year, and the fund had 40% of their income be unrealized gain. That basically means for every $100 that somebody earns, $60 will show up as taxable income on their K1. Well, in a partnership, to the extent that you redeem and capital and it exceeds whatever your tax basis is, that would be taxable income to you. So, that manager having a good close relationship with their tax advisor, hopefully is doing some planning at year end before they're taking distributions and realizing that they have some unrealized gain in the portfolio. They should try to not exceed that estimated tax basis they're going to get, because that will accelerate that income to them. Whether they let it ride, let's say they let that ride, they might not pay tax on that income for some time. And this because distributions basis, as already said, is treated as income. That also can create a problem where there's still unrealized gain within the portfolio. So let's say they redeem that full $1 million, they pay taxes on it, they have their cash, they say, okay, whatever, I got my money, I'll pay my liability, I have money left over. They might get an allocation of gain that next year when those positions are sold, and now they've sort of doubled up on paying tax on that. In the future, they'll get a capital loss to offset, but as Elizabeth mentioned earlier, capital losses are limited to $3,000, so you could really be putting yourself in a bad spot. To the extent that there are liabilities allocated to your capital account, that can give you basis or coverage. So your basis is generally the tax basis plus whatever liabilities, but often those are not a very large number at the GP. So the kind of the long and short of it is, perfect world, you're having conversations with your tax preparer, understanding what your basis is, expected basis, or estimated basis is expected to be, because you're making your redemption request before the end of the year and the taxes aren't done yet, to try to avoid some of these issues. And Elizabeth, I think you experienced some basis issues in your.
Yes, I mean, sometimes we'll see fund managers take out cash and then there's a tax loss, especially, investments in private equity firms or situations like that. And I mean, we're looking to see what kind of liabilities we have. I mean, deferring income is obviously preferable, and oftentimes it can create a timing issue without proper planning.
So it's important to plan and think ahead before taking money out of the fund effectively, or selling any shares or doing any kind of redemptions. Speak to your tax advisor first. And plan for
That's right. Yeah.
So great. So next slide. So we're talking about Section 1256 contracts. I'm going to let Elizabeth take this one. This is not in my
Sure. 1256 contracts refer to a tax classification under the tax law, covering specific types of financial instruments such as futures, options on broad-based indexes, and certain foreign currencies. 1256 contracts have very specific tax treatment that can be advantageous compared to other types of investments. Similar to what we discussed with 475F, at the end of every year, those contracts are marked to market. So any unrealized gains or losses are treated as if they were sold at fair market value. And then essentially what happens is you're creating phantom income. The positive to that is that those gains and losses on your 1256 contracts are treated as 60% long-term capital gain and 40% short-term capital gain, so regardless of the actual holding period, often known as the 60-40 rule that you'll hear. So that's essentially the 1256 contracts. I think at the bottom of the slide, it mentions those foreign currency contracts that we had discussed earlier as well. So.
Perfect. Alex, anything to add?
Yeah, I guess just the one thing, this relates to the incentive allocation. A lot of people in the audience might be familiar with the limitation on getting long-term capital gains for your carry. It's code section 1061. So generally, you need to hold those positions for 3 years before you're going to get that lower long-term rate if you get awarded an allocation. And 1256 is not subject to any kind of holding period. So the benefit to 1256 is not only good for their investors, but for any manager that's getting an incentive allocation, you're not being harmed by that carried interest legislation that was passed and made you wait 3 years.
Got it. And is this, based on the language here, sounds like this is almost solely kind of for the benefit of commodity pool operators or those that trade options and futures and things like that.
Yeah, pretty much. I mean, equity options, so like a lot of the S&P index options, would qualify under this, depending. You have to make sure you're trading the right product, but those are taxes 1256. So an options trader or a commodities trader generally are going to be looking at some of these treatment, some of this treatment.
That brings us to our next polling question. This is a fun one. So how do you manage investors' concerns of receiving K1s later in the year? This is always a tricky situation with alternatives for the most part. All right. So let's get into the management company considerations. So we kind of went through a lot of, GP and some of the specific fund related considerations. This one's more management company considerations. So starting with the first one, we can move on to the next slide. So PTE tax, IRS notice. So did you want to take this, Alex, and run through it?
Yeah. So this is a planning tool that is helpful. We spoke about the SALT cap of $10,000 earlier and how taxpayers are sort of being harmed by that. So one of the things that the states that were higher tax states, let's say, and really honestly, I think at this point almost all states have adopted this, that charge the tax. PTE stands for pass-through entity. So the pass-through entity tax regime. This notice basically said that this was okay for federal purposes. And what this is you can make an election for any pass-through entity, which generally is an S corp or partnership, that is in whatever state you're electing it, such that the partner's sort of state taxable income in that entity will be aggregated at the entity level, and you can pay tax at the entity. And it becomes a credit for that partner and a deduction for the entity. So just a simple example, let's say a New York City-based management company, let's say they're going to earn, $1 million of income after expenses. They decide to make the PTET election, and all their partners are, earning New York City income. what that'll do is it'll take roughly 14% of that federal income and make it a liability for the entities. So there's $140,000 of taxes paid at the entity level, and that reduces the line one income from $1 million to 860,000. So you're getting a federal deduction at the entity level, which makes it deductible. And then that $140,000 will flow out to the partners on their New York K1s. They'll pick that up as a credit. So, you know, it's a way to get around that. So this is helpful not only for management companies, but people, some people are putting holding companies together, you know, husband and wife, or business partners, and using the PTAT regime to lower their federal income tax if they were going to otherwise be capped out by the SALT limit.
Perfect. I think we're good to, we can move on to the next one.
I guess I kind of ran through how that
Yeah,
works.
it's kind of to, Elizabeth, do you have anything to add on the PTAT side? Do you see a lot of this in Texas, or is it more?
Texas is taxed a little differently than some of the other states. It's a franchise tax on marginal income. So we don't have the PTE tax yet.
You don't need it. If there's no,
And we have an exemption for passive entities. So entities that are limited partnerships earning passive income aren't taxed at all.
Got it.
Yeah.
That sounds a little bit better than having to deal with this PTE tax situation.
Right.
And paying the tax, right? So yeah, that's definitely better.
There's no
better scenario.
income tax in Texas.
Yeah. So that's a good point, though. I mean, the PTAT tax really matters when there's a state tax, charge. Now, in the no state tax regimes, does this matter at all, Alex, or is it just not as common?
No, it doesn't matter at all. It provides no benefit. And I guess the other thing I should add is every state has different rules about who can be includable, what income is subject, and you have to make elections by certain dates. If you miss the election, you can't do it. If you make the election, you have to do it. So it's important to sort of understand those rules and timing. And, we talked about the TCJA going away, tax legislation changing. Effectively, for anybody that has not yet made a PTE election, it's almost certainly too late for any of these for 2024. Every state's different, but most of them have you make it in Q1 of sort of the year that it'll be applicable to. So for anybody listening that is interested in understanding this, it's probably a 2025 discussion, 2025 tax. And then, we may have tax law change. It's possible this stays, you don't know. If the SALT cap goes away, you're going to see all this go away. It's going to be not needed because its only purpose is to provide a federal deduction for state taxes.
And what if, what would matter in the case that, Alex, if you had a entity, let's say in New York, and you had 4 partners and 2 of them are in Texas and 2 of them are in New York, you would still have to file the PTE for those 2 New York partners?
Yeah, it's a good question. I mean, it's going to depend on the nature of the income. So if you had 2 partners, but it was a New York-based business where the income was essentially being, treated as New York source, all partners are going to file New York returns. All partners are going to be subject to New York tax, and probably all would want to participate. But if you make the election, it's anybody that's includable will be included whether they want to or not. So it's all or nothing. Well, let's say it was a GP entity, and you had 2 New York partners that were New York tax and 2 Texas partners that were not. It's only going to apply to the New York partner's income because that's the only income subject to tax. So you make the election through the mechanism of the return. It tells you basically lists your New York partner's distributed share or distributed share applicable to New York or whatever the language is, basically taxable in New York. And anybody that's not included in that won't be included in it. So you can make these elections and not sort of harm any partners that are not going to be otherwise subject to that tax.
Got it. That's good. Good point. All right. So qualified small business stock, leveraging the benefit. So Alex, you want to walk us through this one?
Yeah, so this is something out there, maybe private equity investors are familiar with it. It's basically if you can have stock that meets the definition of QSBS stock and hold it for the requisite holding period, you can effectively pay zero tax on that gain. Um, the amount is greater than $10 million or 10 times the basis. There are rules about like what that basis is. There's caps on how big the company can be. It has to be original issue stock, and there's certain other things like that. So where I've seen it be most advantageous is let's say the founders of a company that are able to somehow sell it either through going public or to private equity or just outside investors, whatever that case may be. They tend to have low basis and try to find ways to get the basis up so the exclusion goes up. But it's for the people that it applies to, it's huge because you're basically paying zero tax on it. From a like an operator standpoint, like if you're an investor or you're a tax return preparer, this isn't something that is automatically going to show up on your return. It's something you kind of have to look for. And if you see that the position that was sold qualifies, you need to like as a K1 preparer, you have to pass the information through. As a let's say a portfolio manager or somebody that's looking to sell their company, you should really be talking to your tax guys about it because it's not necessarily something you look for, right? If I'm, Elizabeth probably feel the same way. We're preparing returns for a client. We're not automatically looking to see does their portfolio, anything in their portfolio qualify? Because you have to do a little bit of testing and digging and looking into it. So, for portfolio managers or people looking to monetize a business or sell a business, this is something try to get your head around and then let your service providers know hey, I want to check to see if this stock's QSBS eligible. And if it is, like flag it and then, track it because you have to hold it for a certain period of time. So, it's if you have something that qualifies, it's amazing. That's kind of the takeaway.
Yeah, sounds like a good benefit, but it's tough to find, tough to be in a situation where it makes sense to,
Yeah, where you qualify. Yeah.
it's a niche benefit. So, next polling question. What should be considered to avoid double paying state taxes when using the PTE tax credit? All right. So IRC section 461I, excess business loss limitation. Alex, do you want to walk us through this one as well?
Sure. Yeah, this is I think effectively think about this applying to people that are starting businesses in the startup years or investment managers that are launching the new management company might take on losses the first few years. One of the things sometimes we have conversations with clients on is if they're starting a business, should they be a pass-through, should be a corporation? Conventional wisdom is, well, even if you want to be a corporation later, maybe start as a pass-through so you can get the benefit of those losses the first few years, then you can change classification. But there's a limit on losses that you can take in a current year per section 461L, and the limit is it's 270 for 2022 and future years, 540 for merit following joint. And what happens? Let's say you had $1 million loss. You're only going to get to take that first 540,000 against other income. Now, if you have other trade or business income, you can sort of include that in this number and absorb it that way, right? So like, let's say you started a business, but you're an investor in a hedge fund that's a trader, and you look at all those long footnotes and you find buried in there that, all the income from that K1 is considered trader business income. You can reduce that, limited loss with that. So, that's a bullet point here, trader versus investor fund considerations. When you start a business, you have a management company that's, losing capital, and you're investing in your business until it gets to be cash flow positive. If you're limited on this loss, look through your hedge fund K1s to see if you can somehow take that, or lessen that loss. The good news is, if you are limited, that limited loss the next year will convert to a net operating loss. So that can help accelerate you being able to take it as well. So just something to keep an eye out for if you're in startup mode, or getting a business off the ground that's taking losses.
Yeah, it sounds like it's really only in that situation if you have a new business that's taking tax losses that exceed 270,000. It's important to look out for that.
Yeah.
Great. Bonus depreciation. Elizabeth, do you want to walk through this one?
Sure, and I might need some of Alex's help here. It's been a minute, but
It's less relevant, right? It's getting less relevant every year.
yes, it is getting less relevant. And again, with the new administration, this could all change. But the bonus depreciation is essentially going away as the time passes by. What was 100% bonus depreciation in 2022 is now 60% for 2024, and then further decreases as the years go on. I think end of year planning is probably a good idea for people, management companies in particular, looking to make big purchases where they can expense 100% of what they are buying. Or 60, yes, 60%.
60 now, but was 100.
Yes, I got excited. 60%.
Yeah, that's pretty much it. I think if anything, this is probably a little more known now. Like, it was 100% for several years, and then it started to drop. And some people were caught off guard with that. A few years ago, one of the big plays was people trying to, if they were fortunate enough to be in this position, if you had a very successful company, you wanted to buy a personal plane or a private plane for the business, because you could just immediately expense that, $26 million jet, and, take your taxable income to zero, kind of thing, with the benefit of bonus depreciation. So, it's still a benefit. And whatever, let's say for 2024, you are taking 60% of whatever that asset purchase is, the remaining 40%, you still get to depreciate over where that useful life is. So still, certainly better than if there were no bonus depreciation whatsoever. There's also Section 179 out there, where you can take 100% of that if there's sort of like limits on the dollar amount of the assets you put into place, and then it gets reduced. And I think it's like 2 million and some change. So we've seen this where people are doing like office build-outs. They're like gonna get a new lease, and they were 30 people and they took the space, and now they're 50, and they're gonna like really make a nice office for their clients to come, and they spend a couple $1 million. A lot of those costs are going to fall into what you can do 179. And I think the last thing on this is the bonus depreciation election is automatic. So if you decided that you wanted to opt out of it and use 179, or opt out of it and do some other planning, or maybe you wanted to do tax planning where you're like, my income is low now, but it's going to be higher in future years, so I'd rather get that depreciation deduction spread out. There's reasons why you might not want bonus. You have to opt out of it. It's going to automatically include it in the return. So, something to talk about with your tax return preparer, whether or not it makes sense to look at Section 179, opt out, and some of those things. But at the end, soon enough, it'll be going away unless we get some more bonus depreciation legislation.
Alex, do you know how long you would have to hold you can't just buy a private plane and then sell it next year and get the bonus depreciation tax benefit, right, and sell it. Do you know how long you have to hold it for?
Well, I mean, what would happen when you sell it, right, is you have basis of zero, so then you would have gain, right? So whenever you sell an asset that you're going to take whatever your cost basis is and offset that. So I think in that scenario, you would just the big loss and then a gain. I don't think there's a holding period requirement, actually. I think like and the other thing that's interesting about it is, you can bonus depreciation occurs or you get it no matter when you acquired it during the tax year. So if you bought the asset on February 1st or December 1st, you get 60%.
in that year. Yeah, interesting. I mean, I remember seeing a lot of this on social media going around a few years ago, where everyone was buying Mercedes G-Wagons because they fell under a certain weight category that allowed people to use this depreciation. One of the other things I remember is you do have to track. You can't just write it completely off if it's not for business use. If it's personal use or a vehicle that you use personally, but also for business, you have to really be careful and track miles and what percentage you're using personal versus business.
Yeah, that's absolutely right. I mean, that applies to the vehicles, to airplanes, to any business equipment whatsoever. You have to have good records to show business versus personal use, and if those records are not really buttoned up, the IRS can just disallow the deduction. So that's important for sure.
Yeah, for sure. So great.
So, Mohammed, I think that brings us to the end here.
Yeah. Do you want to do questions if anyone has any question?
Yes. So there's a one.
Mohammed, I think you're muted.
I think question is for Elizabeth regarding 475. They said it is a irrevocable election, but in any circumstances can the taxpayer revoke, or under what circumstances election is no more valid?
I think it would take a private letter ruling to have that election be unrevoked. I think once it's made, you're pretty much locked into it and would have to have pretty good reasonings for why it wouldn't apply. I think maybe at wind down or something like that, if you had reasonable cause to consider maybe not having that election, the IRS would consider it.
So I have something to add on that. So I think that another thing I've seen people do is, if let's say you were a trader and you wanted to become an investor, if you don't qualify as a trader, arguably it might not apply. There's some risk to that. But I do think there was a revenue procedure that came out that said that you could do a change of accounting method. I think there has been some updates to that where there's still a lot of work that you have to do to get out of it, but it's a little easier than it used to be, where for sure you used to have to do a PLR. But there are some guidelines where certain taxpayers could elect a change of accounting method to get rid of it. But it still is quite a bit of work. And I think to the participant that asked, check with your advisors, and then also for anybody that's considering it, make sure you really intend to want to keep it, because it can be difficult.
Yeah, and I think one other thing to consider is if you're making this election and you have a diversified portfolio, you can kind of pull out like some of the partnership interests or other categories and say, I am not electing for these categories. They're not part of 475F here. And that's allowable. So that's something to consider.
Great. Any other questions, Mohammed?
It looks like his screen's frozen.
Yeah.
Yeah.
I think that probably wraps us up.
I think it does.
Great.
Okay.
All right. Thanks everyone for listening, and thanks for joining.
Yeah.
It was a pleasure. Thanks, Alex. Thanks, Elizabeth.
Thank you.
All right. Thank you, guys.